Stanford University.
Like I'm involved with these 7 startups, and for a reason that I have no idea, they're actually all doing okay, which is very rare in startup land. You know, usually if you have 1 or 2 out of 7 doing okay, and 5 of them are, 4 of them are still breathing, and 1 of them is dying, that would be considered a victory. So this is a pretty good time for me, having a great time. So this is a presentation that talks to you about running a company and making it successful while you're running it. Now, you may not know, this doesn't really have anything to do with starting a company, but once you have a company, this is how you actually make the company successful. And then we have a little workshop afterwards per the request over here. So this is Leadership in the Virtuous Cycle, or how I made 40 quarters in a row. I don't know if there's anybody else in Silicon Valley. I don't know how many you guys made, but I don't know how many people. Huh?
36.
Okay, so I don't know how many people can stand. Exactly. Retire at the top, man. So I don't know how many people can say they made 40 in a row, and I can tell you that there's a little bit of luck, but there's also some thought behind it. So. Okay, so Veritas Software, Bill just gave you the highlights. We went from 95K to 1.5 billion, from 12 employees to 6,000. We went from 0. We actually went at the peak of our market cap was about 64 billion. But that was very ephemeral. It only lasted for about a nanosecond. We're in the nano building. It only lasted for a nanosecond. And I was counting my money and saying, this is great, but it didn't last. We went from a startup to a Fortune 1000 company. We became a Fortune 1000 company in the year 2000, at the end of the year 2000. We were Fortune 999. A lot better than 1001, huh? And we did that in 11 years. So there is, I believe, in business what I would call a virtuous cycle. Virtuous cycle, you've heard of vicious cycles, right? Where bad things happen and it causes more bad things to happen, et cetera. Well, virtuous cycle is the same thing in reverse, where good things happen and they cause more good things to happen and they cause more good things to happen. So the virtuous cycle starts out with exceeding the sales expectations. Most people who come out of the environments that you come from think about salespeople as like, if I whip them harder, they'll do more, and I'll make the goal something that, maybe they'll reach it, maybe they won't, but it'll be a stretch goal. It isn't like that. Set the goals realistically on an individual basis. You want to manage the goals in an organization so that 70% of your sales force actually meets their number, makes their number. And the reason you want to do that is you create a culture of success in your company. You build an industry reputation for sales success and for paying well. You attract and retain the best talent in the business. So this is a virtuous thing to do, to say, the way we're going to run the business is we're going to go pay people. We give them a reasonable thing to do. We're going to go pay them well. We're going to attract the best talent. When you do that, you exceed the revenue expectations, right? Everybody's making more than quota, or most people are making more than quota. You do the math on that. When sales overachieves, the end of quarter and end of year discount pressures are avoided. Companies' margins deteriorate when you get to the end of a quarter and you're not making your number. And because you're not making your number, the customers kind of wave these orders in front of you, and they say, if you give me a deal, I'll do it, right? And if you have a lot of business and you're ahead of the learning, if you're ahead of the curve, you can say, hey, I appreciate your thought. See you next quarter, and we'll do it at my price instead of your price. So you want to avoid end of quarter discount pressures and channel stuffing. Channel stuffing is a disease in business. Channel stuffing is described as you have a bunch of channel partners at the end of the quarter. They say, we'll buy a lot of inventory if you give us a big deal. You do the deal with them. Then they sell it off at a really, really, really cheap price. They wait till the very end of the next quarter, and they do the same thing to you over and over again. And eventually what happens is they own you. So you get to avoid these two things. You plan your manufacturing capacity in advance. When you're over your quotas and you exceed the revenue expectations and you know what's going on, you can actually plan to build the right stuff in advance, and you're not kind of running around like crazy at the end of the quarter. And you can build a backlog for the next quarter. The bigger the backlog for the next quarter, the more stature you have in front of your customers in terms of avoiding discounts and kind of doing the right thing. And most importantly, you avoid the temptation of taking the first step onto the slippery slope of ethical and legal misconduct. Companies get in trouble and executives get in trouble when they get to the end of the quarter and they're reaching for revenue. And they say, well, if we just do this one little thing, this quarter only, we'll make the number and then we'll look good. And what happens always is that next quarter you have to do a little more, next quarter you have a little more, and you find yourself 10 years later going to jail. I was just reading up on the recent history of Sanjay Kumar. He's serving a 12-year term. He was our peer. He ran a company called Computer Associates, and he landed in jail. It's tragic, right? Bright, capable, right? I mean, you meet the guy, and he's just very, very charismatic. Exceed the profit expectations. When revenue is above expectation, manufacturing efficiency is improved. When you can plan your manufacturing, your cost of production goes down because you're not, ordering the wrong parts and building the wrong things. You're building in a very efficient way. Discounts are shallower. If there's channel distribution, yields higher street prices. Higher street prices in the channel makes your channel partners happy. If you have deterioration, if you have these channel stuffing that I described where people buy a lot of inventory, then they sell it cheap, what happens is the price that channel partners can make declines, and as it declines, they get unhappy and they become less loyal to you. Am I going too fast with these terms, or are you guys okay with this? Because a lot of new terminology here. Yeah. Okay. Which if I have higher street prices, it increases channel loyalty. When you exceed the profit expectations, operating expenses are a lower percentage of revenue, right? Because the revenue goes higher. So operating expenses are a lower percentage of revenue. And the excess gross margin falls to the bottom line. That's a good thing. And you can either reinvest that in the business, add more engineers, add more whatever, hire more people, or you can make it a permanent improvement in the company's operating model. Veritas did the merger you were talking about in 1997. When we finished the merger, we had an 18% operating margin. Every quarter we did this for about a year, and at the end of a year we had a 30% operating margin. But we never had to go and beat up the employees or do any kind of unrealistic kind of Superman activities. We did it by just managing this so that it worked out. You increase your stock multiples when the profit is above expectation, and growth in profit will exceed expectation. Greater absolute profit and growth in profit and consistency in performance results in higher multiples. Wall Street rewards companies that make the same, that are predictable in their performance and that have high growth rates. And when you have very high multiples, it yields a higher stock price for the same revenues and profits that someone else would do that doesn't have the higher multiples. And higher multiples are also virtuous. Higher stock prices build the public reputation of the company. Very importantly, it provides a reward for the employee base who are oftentimes stock-based. It creates a culture of success across the company. People feel good in a company when the stock prices are rising. Let's see, I had one other point in there, but it looks like it's disappeared. It helps you to recruit and retrain the industry's best. Everybody wants to join the hot company. Rapid growth in stock prices allows for smaller options with a bigger bang. So your use of stock options are going to become more efficient because they have more value to people. And stock options lock down the best and the brightest in your company. So we started out by paying the salesman well, and now what we're doing is having valuable stock options to keep our best engineers committed to the company, right? So this is a very, very, very virtuous cyclical thing. This can help you increase your market share. You invest more rapidly as you become more profitable, and as you have this growth, you invest more rapidly than competitors to take share. You can do that now by adding distribution capability. You add more salespeople, et cetera. Or you can do it in the long term by adding more engineers and building new and better products. So higher profits, higher growth yields the ability to compete more aggressively for market share relative to competitors. High multiple stock also allows you to strategically acquire and consolidate key technologies. The acquisitions that Bill referred to, we did both of them with stock. The companies that we did them with were beside themselves with joy with the amount of money they made on the deal because the stock was so valuable, not only at the time of the deal, but in future times. People were extraordinarily happy with that. And then when you have that track record, people want your stock, and you can go do deals with that. It allows you to reduce the company's cost of capital. Higher stock multiples reduce the company's cost of capital either through equity or convertible debt. So if you raise more equity at a higher stock price, fewer number of shares for the same amount of dollars, you're going to have a better kind of outcome, less dilution. And then, of course, you can do convertible debt. The hotter you are as a company, convertible debt kind of is a bet on the future value of the stock price, so that the interest rates and the convertibility structure of it is a function of the expectation of the company's future stock price. So the better that expectation is, the less costly it's going to be, less costly for you to raise equity or debt. And you can build a war chest. You can build a war chest of cash. When Veritas went public on December 9th of 1993, a day that every CEO who had a public company remembers, right? Veritas had about $18 million in cash. And when I left the company at the end of 2001, Veritas had $2 billion in cash. Cash is really important. Note to self. Anybody's taking note? Write this one down. Keep the cash. Okay, so the people on Wall Street, when you have a lot of cash, will come over to you and to your CFO and to your board members and whatever and say, you ought to do a share buyback, or you ought to declare a dividend. You ought to push the cash out to the stockholders. And as a fiduciary, as a representative of the stockholders' interest, that's a good thing to do. However, unless you're bankrupt with ideas, the cash is better served for you and the shareholders inside the company than outside the company. I was on the board of a company that the stock was kind of meandering around, and the investors were very unhappy, and they kept pushing the company to do a stock buyback. I call them investors in the most gracious of ways, I should say. And they said, let's do a buyback, and they came to the board and said, let's do a buyback. I didn't really want to do the buyback, but when you're on a board, you kind of, management wanted to do it. Everybody voted to do it, so I voted along to do it as well. I did that 3 times. 3 times we took cash that the company had, pushed it out to the shareholders. What do you think the shareholders do when you have a stock buyback? You know what a stock buyback is? You take your, I know you do. Do you guys know what a stock buyback is? You take your cash and you buy your own shares. And when you buy your own shares with your own cash, what happens is the stock price goes up, right? So the company has the same market cap, fewer number of shares, so the price per share is higher. And what do the, quote, investors do at that point in time? Sell. They hit the sell button. So the guys that were telling you how much they love the company and why you ought to do it are the least loyal to the company. They get a pop of 2 points to hit the sell button, they're gone. And what did they leave behind? No cash. So I was on the board of this company. 3 times we go and buy back the shares. Then they decide they want to go buy this company. They invest 6 months romancing the company. Romancing. Everybody's in love with everybody else. They make a stock and cash offer. The company says, great, let's do it. It gets announced. And one of their competitors comes over and says, well, we'll make an all-cash offer. You know who I'm talking about, right?
I know exactly what you're talking about.
We'll make an all-cash offer. And the company said, well, we'll do a little better, yada, yada. And, at the end of the day, if you'll excuse the French, the company with all the cash bitch slapped the company without the cash and said, we can buy anything we want, and there's nothing you can do about it. And when you're the guy getting bitch slapped, it doesn't feel so good, let me tell you. So keep the cash and use it to express your ideas for the strategy of the company and make it into a better company. Yeah?
So what do you think for like Microsoft? They've been sitting around for cash for like years and years. I mean,
they have no ideas. Do they have any ideas? I haven't seen any ideas come out of that place in 10 years, right? So they probably ought to do something like a dividend or something like that, but they're not on a high growth rate, right? I mean, they have no ideas. You have to have ideas. You give cash out instead of having ideas. If you have ideas, if you're bankrupt of ideas, you give the cash out. If you're not bankrupt, if you have ideas, don't give the cash out. If you're bankrupt of ideas, work someplace else. Who wants to work there? Come on. I mean, it's like no fun. Fun counts, doesn't it? Yeah.
So with the company that you were talking about where you voted to do the share buyback, was that just purely peer pressure or what?
Yeah, so boards of directors almost never have votes that are not unanimous. I can't remember a vote in a board of directors that was not unanimous. So you talk and you talk and you talk and you express your ideas, and there's a sentiment in the room, and unless you want to go be like a jerk, you just say, okay, let's go do it. But I was unhappy about it 3 times in a row.
So do you think that as entrepreneurs, do we want board members who would be more willing to vote what they actually think? I mean, how do we screen for that, or does it matter? Maybe it doesn't.
I had a great board of directors. I had people who were, we're talking about one of them, this guy who's the head of Seagate was on my board. These are like real people, no bullshit, they get it. I never had an issue in my board about, I mean, I would never buy back the shares, and nobody in the board ever brought up the idea. I would never come to the board with that idea. If I came to them, they'd probably support the idea, but, we loved each other. And that's one of the reasons they love me is because they didn't come up with these ideas. I said, hey, I got a better idea. Let's go use it. Let's go do an acquisition. Let's go buy something. Let's go build something. Let's go create some value.
Good boards talk through and really debate things. I mean, and I've been through this a lot for stock buybacks, and I'm almost always on the side of not doing it. But in the end, you come to a consensus and you vote on it.
Hey, look, you're on a board of directors. You're not going to not support management. Management really, really wanted to do this. You reach a point where if you don't support management, you change management. If you're not prepared to change management, you support management. It's kind of that simple. You try to talk them out of it. You try to build a consensus. But if it doesn't work, you basically support management. What does a board do? Board basically their power is to hire and fire the CEO. So as long as you're not going to fire the guy, you're going to go support him.
There are a lot of other pressures related to stock buybacks. For instance, every few years you're going to go out and get all the shareholders to vote to increase your stock option pool. Well, you get all these third parties that say, well, whether they haven't used their cash well, their stock pool's too big, because
we were buying back all the option stock with cash anyway. That was in addition to.
See, that's part of it. Is the good companies do also buy back enough stock options to keep the stock pool going. But there's a lot of little nuances in this. But overall, I'm totally in, especially in hard times, because in hard times, if you don't have much cash, it can really hurt you. If you have a lot of cash, you have opportunities to buy things at a severe discount. I mean, really good opportunities.
Look, at the end of the day, if you have enough cash and things are really bad for the company, you have enough money to live and fight another day. I mean, I remember when we went public and we had $20 million of cash, and for me that was like an infinite amount of money. And people said, well, why are you going public? You don't really need to. And I said, well, $18 million of cash, whatever, is enough. That things are bad, we can go do something else with that. That's like, you can build another company with that. Little company at the time. So cash is, as I say in my class, cash is oxygen, oxygen is life. In business, cash is oxygen, oxygen is life. Okay, so the virtuous cycle. We talked about all these good things that can happen. And then the question that comes about is, what do you do to make them happen? How do you, as a leader in a company, someone who runs the company, what can you do to make these things happen? So how can the CEO create and foster this virtuous cycle? So my personal definition of leadership, you create an environment, and this is a very interesting word. Creating an environment isn't an action word. It's a word that describes something. You do a lot of little things and then something happens, right? You're creating an environment. So you create an environment where you can attract the best and the brightest people to your company, where those people can exercise autonomy and judgment, because you invited these people to your company because they're the best and the brightest, and you want them to and then exercise autonomy and judgment in their work. You can't run a company by making all the decisions all the places all the time. So you need really smart, good people who can, kind of further the mission of the organization while exercising judgment and autonomy. And you want to create the environment and get a sense of personal achievement and satisfaction over and above financial rewards. It's not enough to pay people well and to give them stock options. You have to share the glory with them of building a great company. One of the great words I like to describe what I consider good leadership is stewardship. Stewardship is compared to proprietorship. Proprietorship is, what can you do for me today that can make me more rich and famous? That's what proprietorship is. And stewardship is, what can we do together for the future that will make us all better off? That's what stewardship. And stewardship goes to this, is sharing the glory, sharing the satisfaction of building something and being able to look at it and say, we did that together. And so I think it's a very important part. So this is what leadership is. So, sounds good, but it's the little things you do every day that create this attitude and this kind of atmosphere inside the company. But it's a good idea to define what it is you want to happen so that when you make all the little decisions, you know where it is you're heading. So leadership is holistic. Creating this particular virtuous cycle, the one we just talked about, is a very narrow single dimension of that. And the leadership issues are very, very pervasive. It starts with the forecast. Let me tell you, the single most vital piece of information in any company in any day is the sales forecast. There is not a management team in America that doesn't sit down on Monday morning at 8 o'clock when they have their management meeting, and on that agenda every week, what's the sales forecast for the company? It's probably one of the few things that every company does every Monday morning. It's true, right? I mean, everybody does it. When you're doing your operating plan for the company, it starts with the forecast for the next year. If we're going to go do this amount of revenue, then this is how much we're going to spend in R&D, this is how much we're going to spend in whatever, and this is how the whole thing's going to roll up, and this is how much money we're going to make, and yada yada. So the forecast is a vitally important piece of information for the company. It's difficult to have much effect on the revenue line. The further out in time, the more the company can affect the revenue plan. New products, new markets, strategic partnerships, leveraging industry trends and changes, all these things are beyond a year. When you take action to create new products and new markets, they don't really affect the bottom line until they actually happen, which is typically a year out. If you want to affect the current time, these are, as I said, measured in years, not in months. Only tactical programs affect the next 12 months, and they have very limited effect. You can hire more salespeople, but if you hire more salespeople, they usually don't get productive for 6 months or more. So you're on January 1st and you say we're going to have an impact on the year. It's probably not going to be till the second half of the year, and it's probably not going to be that much. Sometimes you can do things like borrowing from the future. This is a bad thing to do. This is what I described before when we talked about making the end of quarter and not giving discounts. When you start borrowing from the future, you're giving discounts, you start channel stuffing and things of that nature. So you can borrow from the future. There's very little you can do. When you sit there the first day of the year and look at your plan, it's plus or minus 1 or 2%, what you're actually going to do, and you can have wishful thinking along the way, but you're really not going to change the kind of the neighborhood that you're in. It's critical to accurately forecast. Now, I would say that forecasting, you guys you're in the sales class? Yeah, so forecasting is flawed, right? All the information you get, everybody's gaming you, right? When you learn that in the class. This forecast that's rolled up in a company, everybody who's giving you information has an ulterior motive of why they want to give you the wrong information. So you got to take this kind of all this bad information and somehow or another smooth it out so you can actually figure out what's going on. We become very expert at doing this, actually. So you want to create a forecast. You want it to be conservative, and you want to have a high likelihood of overachieving it. You make 40 quarters in a row. Trust me, it's 40 layups in a row. You're not making 40 three-point shots in a row. It's grounded in realism. Externally, the pressures of the business are antithetical. Everybody around you is trying to convince you to do more faster. Wall Street, people in the company, your customer, everybody is kind of putting pressure on you, and you put pressure on yourself to grow faster. And it's very, very tempting to be heroic over here. It's tempting to set high goals and inspire everybody to be heroic. It's absolutely the wrong thing to do. You have to be very, very realistic and very careful. And as I said, internally, everyone is gaming the system. Does this sound like a mess? This is really hard stuff to do, right? Success brings temptation to believe in your own omnipotence and indulgence in wishful thinking. I've seen this so many times. You know, you become successful, you start making your numbers, and you say, "Oh, we're so smart, we're so capable, we'll just go for a higher number." And I can tell you that's kind of the path to not success. The most important thing is to be both realistic and objective. Determine the correct operating plan. Once you get the revenue number, you roll it back down into the operating plans where all the ambitions and the constraints of the company come together. It's a battle for resources. Determine the most important corporate priorities and each department priority, and determine a realistic and honest number. It will most certainly be less than the sum of the individual quotas. At Veritas, we used to overassign 20%. So remember, we got 70% of the guys that are going to make their number, remember early back on? Now, if you add up all their numbers, now 70% of the guys making it, some are going to make it way over and some are going to make it way under. All in, they're probably, as a group, going to be over their collective quotas. Yeah? So we then took our number as 20% less than that. So if all the quotas added up to $100 million, our quota internally was $80 million, and our street quota was $75 million. That's the number we gave to the street. And if the salesman ended up doing $105 million, you're a hero, right? If, on the other hand, you set the quota at $110 million and they came in at $105 million, you're looking for a job. Because it's a very, you know that, right? CEO is the least job security in the whole world. This is called an oversign. We did 20%. I'm sure you oversigned at your company. Everybody does. Set each of the operating function expenses at a proportional share of the dollar. Now, remember, what we've done is we've created this smaller and smaller plan, tighter and tighter, plan, rates down the revenue. And now we go to each department and say, you got 15%, you got 20%, you got 10%. And what it forces them to do is to be efficient and drive up productivity. It forces them to do more with less. And that's a good thing. You iterate through the negotiations to an agreed upon plan, which becomes eminently achievable. So a little review, start with a realistic number, overassigned by 20%. The total of the SR goals is equal to 120% of the corporate number. 70% of the sales force makes their goal. Guess what happens? It's a layup. Trusted relationships. How do I get the honest number? Remember we started out earlier saying the forecast is flawed, everybody's lying to you. How do you how do you negotiate with your EVP of sales and his people so that they give you a number that you can go build the company on? And I describe an honest number in this case as the highest possible number that you will certain that we will make. That's what I want my sales VP to tell me. Anything less will inhibit our investment in the future of the business. Now, negotiating with sales executives about forecasts is a difficult process because sales executives have grown up all their lives negotiating quotas with their managers. And there's nobody that's more expert at telling you why a number is unrealistic and can't be achieved than a sales executive. They are the world's best at that. They've been doing it. If you want to be successful in sales, it requires two things to be successful. You have to sell a lot, and you have to negotiate a low quota. Right? And these guys are the best at it. So when you go and they say, give me an honest number, they give you a dishonest, basically they try to give you a dishonest number. But I want to make sure that we can invest in our business. I wanted the maximum investment in R&D, the maximum investment in customer service and everything like that. And I don't want to be surprised at the end of the year beyond, kind of what we've all agreed to. And the question is, how do you get that to happen from someone who's habituated all of their life to be, great negotiators on their quotas? You build and maintain a high trust relationship with the EVP sales to engender trust with people, particularly if you're a leader. You have to go first. You have to step up and trust people before they will trust you. Now, it doesn't feel good when you do that. If you trust people, if you trust enough people, if you go first enough times and trust people, your trust will be betrayed at some point in time. Someone will take advantage of that. But I would assert to you that the cost of being betrayed once in a while is a reasonable price to pay for the trust that you can engender with most of the people most of the time. So you go first and you trust first. You express trust first. And you break the cycle of gaming the system. So what I did was I went to our EVP of sales and I said, this is the honest number that I want you to give me. And I said, when you give me that number this year, for the first time that we're working together, I will not come back and negotiate with you for more, because that's what they're worried about. If he gives me $100 million, I'm going to come back later when we do all the budgeting and everything and say, we really need $104 million, right? So he's always got a little in his pocket. Say, look, whatever number you give me, we're going to live with that. And I'm not going to come back and go, that's the trust part on my part. And I know he's going to still sandbag me a little bit. I'm going to do it anyway. And I'm going to make the whole company live with that. And then next time we do the exercise, I'm going to say, remember last time I said I wasn't going to negotiate with you? I'm not going to negotiate with you, and I've proven that. Now, give me the honest number. And in addition to that, I took my VP of sales off of his revenue plan, and I put him on my plan. I put him on you will make a lot of money when the company gets corporate results. You and I are doing the same thing. In our case, we use EPS, earnings per share, and that's the way you'll be compensated. And whenever you have to make a decision out there in the real world, I want you to think like me. Okay? And that's an act of trust. When you tell a sales guy, I'm going to pay you for doing the right thing for the company, and you have to make your number, but I'm not going to hold you on your number in a comp plan, that's a big act of trust with that person. And of course, you give them a lot of stock. That's always a good thing to do with someone who's valuable. So leadership, looking beyond sales, create a high trust environment with and between the entire management team. Not only me and each individual, but each individual to each individual. Okay? And that's something, that we could spend a lot of time talking about that, but you want to do that. The aura of trust and the transparency of style spreads throughout the company. If you can create a trusted relationship among the senior people in the company, and you can create the culture in that group that says, we tell each other the truth, we don't hold back, we don't have hidden agendas, we work together for the benefit of the company. When you create that environment, it starts to permeate the rest of the organization. They walk out of the room and carry that with them. It pervasively diminishes gaming of the system, enlisting the energies and talents of the employee and population in the mission of the company above the mission of the self. You can tell a company that is not political, you can tell a company that's political when you hear people talk about career planning. I'm planning my career. I'm out for what's good for me, and that's all I'm worried about. And when you get to a company that's not political, they talk about, this is a great company, we're going to go do that. We're going to go climb this mountain and do this wonderful thing. And their career gets taken care of because the company just kind of pulls everybody along. It's not in the presentation, but I can tell you that the first step in creating this trust inside a company and this sense of mission above self is information. Political companies are based on secrecy. What I know and what you don't know makes me more powerful than you. And if I'm up high and I have a lot of secrets, then I'm very powerful. And if I learn some secrets because I'm because I'm kind of in with somebody, I become powerful in the organization. And it's the CEO of the company, the number one leader, that has the ability to change that. And the way you change that is you tell everybody everything. You bypass the system and you kind of globally tell everybody everything. One of the things we did in our company, this is a very interesting thing. Have any of you guys worked in real companies? Okay, so the Monday morning staff meeting, kind of the best way to describe the Monday morning staff meeting in a company is all the senior executives, they walk in a room, they shut the door, and occasionally a little puff of white smoke comes out of the chimney. A new pope has been elected. And nobody knows how that happened or why. It's very, very mysterious what goes on in a staff meeting. And everybody's always sitting there like, I wonder what they're talking about. It's true. So being the company that we were, being very open, we said, there's some things we talk about that are secret, but most of it's not. So once a month, we're going to offer to all the managers in the company worldwide the opportunity to dial in on a phone call, and we're going to have our management meeting in public. We didn't talk about, we didn't talk about 100%, but we talked about 87% of the things you can talk about in public. And the first time we did that, man, you just couldn't get a phone line. I mean, everybody was dialed in. 6 months later, people were too busy working. I have no time for that stuff anymore. People just lost interest in it because it's like, they're doing one of those things again, right? Same old meeting. It's really interesting. But it's a huge act of trust to take this mysticism out of this whole thing. And when you do these things, this is what makes the virtuous cycle continue. So some words to live by. This is the end of the presentation. I have a couple of things to share with you before we wrap this up. This is as you think about your futures. Regret for the things that we did can be tempered by time. But regret for the things that we did not do is inconsolable. Okay, so you're all sitting there at the front of your careers. And you have to make a lot of decisions along the way. And I can tell you with absolute certainty, if there's things you want to do, go do them. And don't find yourself sitting there 25, 30 years later saying, woulda, coulda, shoulda. At least try. You may not be successful, but at least try. Shakespeare said, better to have loved and lost than never to have loved at all. Same idea. It's regret for the things that we did not do that is inconsolable. And I love the word inconsolable. It is inconsolable. So I think that's an important thing for you to think about as you go forward in your life. The other thing, especially if you're going to be a CEO, if you want a friend, buy a dog. That's my dog, Roxy. And I can tell you, if you you come home from work and the dog's there and they're happy to see you and don't ask anything from you, they just love you. That's the only friend you're going to have. Okay, so I think we're at 5 minutes for questions and then we'll do the workshop. Is that about the right timing here? Okay. Yes?
I read online that you support private offices for creative workers. I was wondering.
I'm sorry, private
offices instead of having open cubicles?
Oh, yeah, that was, you looked at Wikipedia, I guess. Yeah, so that's, it's kind of funny, That was written by the engineers at the time, and it was a big deal back in 1989, 1990 that every engineer got a private office, And I'm on the board of one of those guys who was an engineer at Veritas. He decided to start his own company, and he pulled me in, and I'm on the board of his company, and he's got this, big bullpen filled with desks, and everybody's in the room with no offices, no cubicles, no nothing. So the style has changed. At the time, that was considered a big deal. But today, nobody likes it. Everybody says, well, let's just go have a big room, everybody can talk to each other. So, as I said, it was a big deal at the time, but I don't think it's not a big deal. We did, it wasn't about the private office, it was about make the engineers happy, right? We were very, I could tell you there's few people who were as cheap as me when we started the company. I was a very cheap guy. Everybody used to complain about how cheap we were. But one thing I was never cheap about was giving engineers equipment to do their job. They always had whatever they wanted and they had the best. Because I think that's an investment in productivity. Yeah?
What are some of the 13% or whatever of things that you don't think management should share with the company?
I mean, what's the stock option list? What's the salary list? There are certain regulatory issues when you're a public company that you have information that is considered insider information that you can't share. And there's, it's a de minimis thing. I mean, we were a very, very open company. We went public, and then we kind of wrestled with the problem. What do we do now, right? Because there's all this regulation. And we thought about it for a while, and we came back and we tell everybody, look, we can't tell you everything. We used to go into a meeting, we used to tell everybody everything, tell them the forecast, what we're going to do. We used to tell everybody everything as a private company. And we came back to them after we went public and kind of digested that for a while, and we said, look, here's the deal. We will have a contract with you that for all company of our size and shape, we will aspire to be in the 95th percentile of being open with you. And that was the kind of 95th or better percentile. And that was our contract with our employees, that we will be open with you, we'll give you all the information we possibly can. I never asked the question, it's a very interesting, the semantic impact. The question is, should we tell them? Is a question that many, many management teams ask themselves. And I changed that question in our company, Is there any good reason why we shouldn't tell them? It's a big difference, right? Should we tell them? A lot of reasons not to tell a lot of people, a lot of things to a lot of people. But is there any good reason, any good business reason why people shouldn't know this? And usually the answer is no. And so we were very open. We had a reputation, big reputation of Veritas was our openness.
So would you trust employees to, like, if you had some, competitive strategy or something, would you trust employees and share that strategy with them, even if it might hurt you if competitors found out? Like that kind of
Yes, I would. Let's follow that through a little bit, okay? I got a strategy that I want to go to the market with. Who's going to go to the market with that strategy? The engineers, the salespeople, right? It's the company. I can't say, go build this, and I'm not going to tell you why. And I can't say, go find these customers, and I'm not going to tell you why. I got to give them good reasons that make sense to them and make them partners. Is there a risk that a competitor will find out what we're doing? Absolutely. But that's not important. I said you can be betrayed sometimes. That's not important. The goodwill you get from sharing is far greater than the risk you have of betrayal, my opinion. Yeah.
Working at Veritas, how do you balance your engineering versus sales? I'm just curious, given that that article is sales and lean curve.
Yeah. So so let's give you my bona fides over here. I was a physics major coming out of college. My first job, I was a software engineer. I wrote operating systems in the good old days with punch cards. And I had a 360/50 of my own that I used to sit in front of the console and actually set, register stops and things like that. I designed and wrote the first ever software hypervisor in 1969. So I'm a technical guy, and I love the technology. In the business that we're in this community of high tech, companies have a drivetrain, and the drivetrain is product and sales, and I value them equally. It's all about getting great engineers and building great products, and then great distribution and great salespeople and selling those products. And we used to have time inside the company when we used to talk about these things, and I'd say, look, everybody wants to go hire all these guys. If it doesn't make us more productive in building or selling products, I don't really want to hire them. So you have to go convince me that this is going to make those guys more productive. I'm a believer in engineering, sales, and nothing else in these kinds of companies. And I'm a technical guy in my heart of hearts, let me tell you. I wrote file systems, yeah. Go ahead.
You talked a lot about sort of maintaining realistic expectations so you continually exceed them. Is that more important in a public company? And when you're back at a private company, did you set expectations higher?
Yeah, so who wants to be in a private company that misses their numbers all the time? It's the same thing, right? You report into the board, everybody in the company knows that you tried to do $12 million and you came in at 10.2. You feel like an idiot, right? For the same 10.2, if you set the goal at 9.8, you'd be a hero. It's pervasive, right? Look, if I get in the car, if I leave here today, if I get in my car and it's 5:30, if I sit down in my car at 5:30, I live in Portola Valley. Portola Valley, worst case, 15 minutes away, right? 20 minutes away, right? I'll call my wife and say, I should be home between 6 and 6:30, right? Probably 6:15 or so. So I've given myself a 45-minute window to make a 15-minute trip. I walk in at, there's a little bit of traffic. I walk in at, 5 to 6. Hero or bum? It's pervasive in my life. I don't even know how to do it any other way anymore. Anybody here married? You ever come home late? There's an easy way to solve it. Set the expectation for later and get there earlier. Does your wife get mad at you?
I'm not married.
Huh?
I'm not married.
Is that going to be
I'm sorry? You're not married? Huh?
No. Talking to him.
Yeah, I was talking to him. He said he's married. Okay. Do you want to get married someday? So listen up, will you?
For more, please visit us at stanford.edu.